Any stocks mentioned in this video are held in the fund, may be traded at any point and not be treated as advice or investment recommendations. Views from the fund manager are not to be treated as advice or guidance of any form. Welcome back to Vantage. We're focusing on income today, and we are revisiting an old manager who's been on the show previously. Sid, welcome back to Vantage.
Thank you very much, Neil.
Sid, I mean, let's start with you designed and launched the Muldra Multi-Cap Income Fund way back in 2011, I think it was. So coming up to 15 years. For anyone who hasn't come across the fund, maybe just walk us through what you're trying to achieve and how this approach perhaps differs from other UK equity income funds.
Absolutely. So this is, from the word go, a very different fund to what you will find in the equity income sector. So it is a diversified pool of stocks that we very carefully handpick based on quantitative filters. Look at the balance sheet, look at the free cash flow, look at the cover and dividends. And actually, it's very different to the large cap bias that most of my peer group will have. It is why we launched the fund. It was meant to be a small mid-cap UK equity income fund that aims to beat the FTSE All-Share Index yield over time. And as you're probably aware, we have done that every single year since launch, including through COVID. And that was actually one of the moments where the real proof of the pudding was sort of, can you do it even when so many companies are cutting their dividends? Beyond that, there was also the idea that the Investment Association, which is what dictates the UK equity income sector qualification, said, well, actually, we will exempt those funds that wish to drop out from the yield test in this particular period. And so we had a very deep sort of philosophical thought about this, that, should we drop the dividend test and just buy a whole bunch of growth stocks or capital growing stocks? And we still debate that as in retrospect, was it the right move? But looking back on it, I think that consistency of yield payment did set us apart from our peer group. So whereas some funds, and this is not a criticism in any way, may choose to buy those stocks that pay any dividend, we will have a filter of a minimum of 2% and growing. And similarly, there is a larger number of stocks to choose from. So not only do we have a greater pool in terms of the non-FTSE 100, but the number of stocks held in the fund is also larger. So we will have typically 100 companies, or sometimes 120, sometimes 90, subject to market opportunity. But that gives us a very different hunting pool, if you like, that allows you to sit alongside a large cap income fund. So if it comes across as me being anti that, it's not. I'm in favor of all of these companies that pay great dividends, and we have some wonderful British companies. But what this is really designed to do is sit in that smaller market cap size across different sectors, and offer an uncorrelated dividend.
I'm going to come back to that because the yield is an important part of it. But you also talk about this comparison between large cap and what you're doing. It has been challenging. There's, in the US, you talked about sort of narrow leadership. Are you seeing similar kind of effects here in the UK, where I think you quoted this stat that there's been a concentration, the large cap concentration in the FTSE 100 has been even more pronounced. And I think the number of companies making up 80% of the market is roughly half since 2022.
That's right. It's now 66 companies. I quote that actually from the Deutsche Numis index review, which they do annually. So that's very obvious that it has become more concentrated. And from an asset allocator's perspective, if you look at that, you could buy 4 income funds and think, great, I've diversified for my clients. But chances are that they are likely to be holding a huge degree of stock commonality within their top 10. They will typically be the HSBC, Glaxos, Shells of this world. Nothing wrong with those companies, but if you've held them 4 or 5 times for your client thinking you bought different funds, and this is no insult to any of the asset allocators, I think there are very competent fund selectors out there. But what is happening is, just by way of what is the choice available to you, well, you could just buy an ETF for the same thing, or let the individual buy the same 5 stocks or 15 stocks that actually make up such a large chunk of the UK FTSE 100 for that matter, for £10 on whichever broking platform that you use, and so that there is no real differentiator there, unless, of course, you think that those will be the stocks that outperform for the next 5 years.
Yeah.
So it's already sort of happened in this last period, as you described. There has been a very large cap-led rally, and in those circumstances, the fund design does not allow the mandate to outperform. It's very difficult to do that.
Yeah.
Because it isn't commodity heavy, it isn't tobacco led. In fact, that's something we've avoided as a sector from the first day.
Yeah.
And quite rightly, actually, because there is so much more to choose from.
And I think, look, I mean, you look at these things over an extended period of time. It is interesting that you're seeing this call for diversification. It's been, a lot of sort of shocks to the system, a lot of news flow that impacts market volatility. So it feels like, that diversification is starting to come in, and that concentration risk is now becoming into focus. So you might be well placed for that. The income is something that is standout. So someone who's looking for reliable income in a, which is different from a sort of concentrated basket of large cap stocks. I think this is really interesting. You walked us through, all the reasons. So you've got a bigger pool of companies. You're focused in small and mid cap as well as the sort of large caps. You were able to sort of continue paying the dividend through the pandemic, which I think is a great sort of testament. What I'd like to understand is, how do you go about ensuring that the dividends are sustainable and well covered? What is the fundamental work that you do when you're bringing companies into the portfolio?
So there are two basic tests that we look at in terms of the financials: the balance sheet, to ensure that there's either net cash or there's low gearing with regards to the net debt to net asset ratio. And everyone has different definitions of gearing, but we like to see that below 50%. Sometimes we'll make allowance for it if there's an acquisition strategy and it's temporarily high, but it's going to come down, fine. Or if the business model so dictates that it must have gearing for a period of time, but actually it's very cash generative, and on another metric, maybe net debt to EBITDA, it's not high and it's sub 2 times, that's okay. But generally, and we monitor this pretty much daily, weekly, whenever there's a results update or a new note, we'll look at the quants and say, okay, well, where are we on the portfolio? So for the average, on a weighted basis, we're at 6% net cash, actually. Yeah. So that's quite powerful across nearly 100 companies. And similarly, the free cash flow is very important, because having another pillar of strength to essentially back up that dividend in a sustainable way, the free cash must cover the dividend at least 1 times, but preferably 2. And that's where we are for the entire portfolio. It's 2 times at the moment on a weighted basis. So that is on the higher side. And you may laugh at this, but typically it's sort of 1.8, and just that 0.2 difference is quite hard to achieve, actually. And so it takes a lot of work, and you have to sift through the companies. But the third part of this really is the management meetings, and having a track record of under-promising, over-delivering, but also actually really having that feeling that you're not pressuring the management team, that they can afford to pay you the dividend, they want to pay the dividend, and it's not in any way compromising their own growth story.
Yeah.
Typically, I'll be in a meeting where, if there are other fund managers, there will be the growth side who will be saying, do share buybacks. We want that as a preferred form of capital return, boosts the EPS, forget the dividend. So as an income manager, I'm constantly defending why actually having a steady dividend record is also attractive.
Yeah.
And I don't want to be in a battleground with a management team to sort of say, well, I think you should pay a dividend, not a share buyback, because if you can't afford it or you have a preference, well, that's a board decision and that's fine. But if you want our capital to support you over a very long period of time and stay on the register and support you with placings, which actually ultimately also fund growth, then there should just be an honorable commitment that you can cover it, you can clearly afford it, which is why we're meeting, and that you're not going to compromise that through some empire building strategy that potentially puts the entire company at risk. So that's the sort of the filter of it. But I think in reality, it also comes with a bit of judgment and experience. You can't just go on the quant filters and say, oh, well, that ticks all the boxes. Yeah. Great, that's a purchase, because management teams change. And sometimes that in itself can be a trigger. So either you can see that somebody's come in with a previous record of managing the company very well, or otherwise. And that then for us is a reassessment of the whole thing again. And so really it's a constant exercise of meeting these companies
Yeah.
to appreciate whether we can hold fast on what we think we're buying into.
Yeah, and one of the things, so clearly, you do take views on companies, you sort of in and out of companies. You're very open in your recent commentary about what worked well and what didn't. I think that's a great trait. You sold Dunelm before the profits warning, which is well timed. I think you also mentioned Man Group though, where you had sort of come out of it, but then it continued to rally. When you reflect on what has happened and the decisions that have been made, how's your process help you weigh up when to hold and hold your nerve effectively and when to move on?
Let me just, I would begin by saying actually there's no glee in exiting a business that we've supported, which then suffers.
Yeah.
It's of course it's helpful to protect the capital, but it was really triggered by two things. The first was there was a change in CEO.
Mm-hmm.
So the last call that I had with the then outgoing CEO, for me, was not necessarily the best one, even though everybody else that I could detect on the audience in that call seemed super happy with it.
Yeah.
And I felt I was the odd one out. And actually studying the balance sheet. So if you look at the net debt to net assets ratio, which is what I'd mentioned earlier,
Yeah.
and you go back to 2013, it used to be a net cash business, closer to sort of 45 million, maybe even 50 million before that. And very steadily it moved into the net cash deteriorated and the net debt started to increase. And it got to a point where we kept sort of thinking to ourselves, okay, fine, but that's temporary and there's a reason for it, and they're increasing the SKUs and they're investing in the business and there's technology coming and that's fine. And it was a good moment for me to just reassess it all and say, well, look, we've got Christmas trading coming up. There's quite a lot going on in UK consumer with different perceptions. There's going to be winners and losers. This is a point now where the gearing's gone past my comfort ratio.
Yeah.
And I think it's right to step off that train
Yeah.
and maybe reassess it down the road. Equally, so yes, this turned out to be the correct move because subsequently it was not such a strong trading update and the shares fell. But maybe at a future stage, if the balance sheet is in a better position and they're trading well, we will come back to it. So I wish that business well. There is no bad feeling in any way there. With Man Group, that was absolutely an error. But just to go back to what attracted me, I liked the management team, I liked the brand, I liked the fund managers and the strategies. The AHL strategy had clearly become more dominant and it was underperforming for a period. And if you look at the share price in 2025 between January and September, it was something like minus 27%. And so we'd given it quite a period of time where it was doing nothing.
Yeah.
And yet the general rhetoric was, we're going to be okay, we're going to be okay, we're making some changes, we'll rework the factors, it will be okay. And the realization for me then was that if it's not okay, it's pretty binary.
Yeah.
And this will continue to suffer and derate. So at that point, we did sell out and it was a mistake because from September to, I think it was January, it rallied something like 60%. And again, I'm not hurting about that in the way that you might think I am. I am regretting that I sold it, but I'm happy for the business that they did.
Yeah.
And just at the same time, if I could follow it up, what did I learn? I learned that actually it might be right to hold on to these businesses where you liked these qualities and believe in the team for a bit longer. But it is harder in a period where UK fund managers have seen greater pressure. So that luxury of being able to be a patient investor has gone. Yeah. It's a very fast moving market. If momentum's against you, it can carry on for much longer. But equally, I tried to take that experience and say, okay, well, in September, what else was working? What meetings did I have that in the same sector may have given me a slightly better experience? And actually Schroders was one of them. So I had a good meeting. We built that up gradually. Jupiter was another one.
Yeah.
Again, in September, had that meeting and gradually built it up. But between September and January, I think while those went up maybe 30, 40%, of course, this went up more.
Yeah.
Subsequently, of course, Schroders has been bid for, as you're aware.
Yeah.
So that's been a result, and it doesn't look too bad now. But it was not a straightforward switch, take that position and put it into these two, because it takes time to work those, as I was saying, in the process, to try and actually go through the investment, understand it, get comfortable with it. And the way we do this thing is really to see the evidence and then reward it by adding a bit more, get another report and continue to add in that way. So as more information comes to reconfirm what we think it is, we then adjust the weightings upwards accordingly. And it should earn its place. And that's pretty much how it's done.
Yep. In a diverse portfolio, you've got a couple of very interesting clusters which I want to explore. The first being an allocation to the gold miners. So you built up, I think, meaningful positions in gold miners like Endeavour, Lundin, Anglo Gold.
That's right.
Gold isn't necessarily a sector that people associate with equity income. So, firstly, how did it come onto your radar? Was there a macro overlay or a thematic overlay that sort of came onto it? And then how does it sort of fit your criteria, and why are these companies in your fund?
Sure. So you're absolutely right. Gold isn't typically thought of as an income basket to go and find a whole bunch of stocks like the financials would be, for instance, or insurance would be.
Yeah.
But there have been a couple here and there. So Sentiment Egypt used to be listed, and actually that was acquired by Anglo Gold Ashanti. So that was a little sort of look into this much larger global business with other African assets as well. It met all the criteria. So it has net cash forecast at $1 billion. It's on a P of 10. It yields almost 5%. The free cash covers the dividend on the forecast. So it seemed, of course, with a gold price bull run that's been going on, it seemed right to look at it, carry out the meetings, of course, by conference call and assess. And so that was the beginning of Anglo Gold as a position, because we had held Sentiment in the past. So so that was one of those. Prior to that, there used to be others like Petropavlovsk pre the Ukraine crisis, but it was a low yielding gold asset, and it was sort of only 2% dividend yield, so only just in the radar. But the others, you're absolutely right, tend to be sort of very low yield or no yield, and not really for us. And typically with high gearing, so they'll turn up with sort of increasing requests for new equity or cash to do exploration. And what we like to see as an existing asset, and this is similar in oil and gas, in the few occasions that we would go into that sector, that you must have a producing asset where you can have cash flow that's or at least part self sort of fund your own exploration, so that you've got something to back it up. And I think that is the preferred combination. It's something that I learned from my previous colleagues in George Finlay, and actually we've carried on that philosophy when Giles and George used to do it that way. The current team I think they've adopted that stance on a whole range of other stocks. So there is a team effort in this space. I think, speaking of that, with the More Special Situations Fund, which I used to work on, but I'm of course on the income fund now, they have continued down that road and developed another analyst there in Harry, and Harry speaks with my analyst Will. So they were exchanging ideas, and increasingly these dividend-seeking ideas come along. And Will mentions to me, you should have a look at Lundin. Maybe there's something there, and so we did a bit of work on that. And Lundin was this great asset, actually, in it's Canadian listed, but it's got an Ecuador asset, and again there are a number of different catalysts that are still coming out, but quantitatively it meets all the filters. So again, you've got $1 billion of net cash forecast. You've got free cash covering the dividends. It's a high teen P, but it has also very high grades per ton in terms of the gold that it's finding. And then there was another idea actually in Pan-African, which I have held, but I booked the profits in that. And one of the reasons for that one actually was we've had that regardless of the gold price in the past. Now that the gold price had such a run, actually some of the less economic projects of its old portfolio looked more interesting and actually viable. So we could come back to it. The free cash gave that buffer for it to pay dividends. It became a bigger company. It moved from AIM to the FTSE 250.
Yeah.
And we made 75% on it pretty quickly. So I felt that it was the right place to be as a sector, but to keep our process on the quantitative filters intact.
Yeah.
with the larger businesses that I've held on to, in this particular case, there is a degree of comfort because it's a wider portfolio and it's more liquid. And I think when the gold price does correct, because it will at some stage, it gives me the option to move out of it faster.
Yeah.
Whereas if you're stuck in a really small company in this sector, it'll be very difficult. Now, actually, Pan-African is not a small company. And I have a long association with them and I wish them well and I hope it carries on doing well. But it's a FTSE 250 versus something like Endeavour, which is FTSE 100.
Yeah.
So again, that's another company that's potentially promised $1 billion in shareholder returns over the next sort of 3 years, and it could go to $2 billion if you were adopting spot pricing. Now, all the 3 companies that you've mentioned that we still hold are factoring in lower gold prices, so something like $3,000 typically, which I prefer. I would much rather have that as an assumption in the model than maybe, let's say, an oil and gas stock, which is assuming $65 and has a $60 break even. And I think that, when your current spot price is only 68, 69, it's a bit less of a cushion. So that is why I think gold was preferred as a sector. Of course, you've got the run and it stays stable in a relatively uncertain geopolitical environment, led by America in part, but you're already there. And I think the reported results will likely show that the numbers have not been affected by the recent gold correction, which actually is still very high because you had a 20% run in January alone.
Yeah, no, it's sort of, you have that sort of fall and it's made its way back.
Yeah.
The other cluster, which I think is really interesting, I mean, there is a linkage because ultimately gold has held up. I think there's interest in it. And also there is expectation that if it continues running, you will see further consolidation in the space, which brings us neatly into the sort of next segment, which I thought was interesting, which is the insurance sector, classic hunting ground.
Absolutely. In fact, I must mention one more thing, which is there was a further sort of reconfirmation for us.
Yeah.
And this is a compliment to your colleague, Lord Ashbourne, actually.
Yeah.
He came and gave us a bit of an educational piece on gold.
Yeah.
Relatively early, I think it was maybe spring, summertime last year. And he made some predictions about the gold price, which at the time would have sounded fanciful, but I bet you he's laughing now.
Yeah, absolutely.
So again, compliments to Edison on that one, because it does give a bit more sort of backing and substance when you hear it from an expert who specializes in the sector.
Yeah. So the other theme which we're talking about is the insurance sector, classic hunting ground for income investors. But there is this additional dimension now to it, which is consolidation. So you own Zurich. Zurich ended up bidding for Beazley.
Yes.
You've got other exposure in the sector. I think Chesnara.
Correct.
So what's your sense of, firstly, you clearly, it's an area which has got all the attributes effectively of good quality income players. But what's your sense in terms of value realization in the sector? Is this a phase where you're going to see broader consolidation across UK listed financials, and how you're thinking in terms of your positioning around that?
You're correct about the consolidation, which has kicked off not just in the UK, but also Europe. So if you look at what happened with Balois, Helvetia, that was a start. I think Zurich coming for Beazley is in a way not a surprise. It's a very good time for them to do it because the rate cycle has not yet hardened.
Yeah.
So why would you do it later on if you like the asset? You would do it now where you don't have to pay a higher multiple of profits or cash flow. You mentioned Chesnara. Well, yes, Chesnara is doing something very different. They are the acquirer here. So Chesnara is buying books, closed live books. So they've done the HSBC UK deal. In fact, just yesterday they've completed, or not completed, but announced that they have gone for the Luxembourg book as well. And so that I think is an exciting space for them. It's a new entry, so they will get the economies of scale from it, and it's under a new team. Again, it's a business that's been considered very boring in the past, which sometimes actually boring can be good, but they are presenting very well. As I say, it's a new CEO, new CFO. And they seem to be doing all the right things, actually, because it gives them, I think, that credibility. And it isn't just a UK business, it's a global business. Of course, Zurich is a much larger global business, but Chesnara in a different space.
Yeah.
So I think that they're in a sort of a niche in the sense that they're going for the size of book that is not that interesting to anybody else. And yet you can spend 100 million and have an earnings enhancing deal within a year or 2 years. And so the cash flow benefits from that then cover the dividend for several years, which is where the attraction comes for me. So you get the capital upside as well as the dividend. In another sense, I think there are other businesses as well that one could consider. So there's NN Group in Europe, but bringing it back to the UK, we like Hiscox. That's a good business too, and it's had a read across from the Beazley bid. So there has been a kind of a relook, if you like, where the shares, I think, were up 10% on the day on that news. So again, I think there is a cycle for these things, and it is more true in insurance, relatively speaking, that you can potentially buy things in the down cycle when rates are low and sell them when they're higher, and then come back to it, because it is almost inevitable. There will be a cycle.
Yeah. The final thing, which in terms of the theme, which I wanted to explore was, you've had a slightly weak jobs report in the UK. There's, you're looking at yields. There's a general expectation that rates will start to be cut from the sort of 3.75 heading towards, depending on who you talk to, 3.25, 3. You've got some interesting exposures that benefit effectively from rate cuts. So real estate, house builders, banks. Walk us through how you're thinking about where UK rates are going, and how you're positioning yourselves. But also, inflation is one of those things. It could always come and shock you, right? So how you're also mitigating against the downside.
Okay, so we did introduce more banks previously when actually we thought rates would be cut faster, but that didn't happen. Inflation was not transient. It was actually there for a lot longer. The other factor is actually this aspect of structural hedges, which maybe had not been appreciated. So whether it's NatWest or Lloyd's, you'll hear them referring to it increasingly, and that gives them this confidence that actually even in a lower rate environment, they will still make their spreads and they will be fine. But generally speaking, you can have lower rates, but at that point, it should also then trigger greater loan growth at some point. And I think that takes time to unfold. So while it's all right to have some of the higher quality, well-positioned banks, we also have the likes of Paragon, which benefit from buy-to-let. And I think that will be a sector that will come into its own under a lower rate environment. So that will be a demand-led phenomenon, really. But it is more of a challenger bank. And then stepping aside from that, I think in a lower rate environment, the obvious beneficiaries are, of course, property. We don't have as much in house builders today, but we do have the likes of the self-storage companies, for instance. We had the likes of London Metric, which we've seen graduate from being a smaller company into the FTSE 100 and continue to hold it. And actually, even within that space, there are some new entities, if I can put it in that format. They're not that new, but the likes of Cirrus Real Estate have done very well for us. I think actually a low rate environment can be quite good for the infrastructure construction businesses on top of that. And then that spreads into utilities, but not across the board. So if you can find those businesses with the right balance sheets, like the Morgan Sindals of this world or the Caliphate Tries, they continue to win business and good order books with, again, great management teams. That to us is really the sweet spot, because they are already doing well. And so if you get the rate cut on top of it, there's likely to be a further boost. And it may not just be in one or two segments. I mean, today water is doing very well, fine. But actually going forward, if fit out for Morgan Sindall slows down, there might be something else that does very well. And so I think that's really sort of the next chapter for those companies.
Yeah, and it's interesting. So I think the way I read that is you are, and there is an anticipation of rate cut, but the way you protect yourself is by great quality businesses, which that they're going to continue outperforming regardless.
There is another part to this, which is really down to I think the companies that have suffered in high rate environments. So where there's been either high capital intensity, not necessarily because of their own balance sheet, but it could also just be perception. It could be the demand side from the consumer has slowed down. So again, you need a kind of a revamp in the offering for it to work in a depressed environment, but then have a nimble enough team to say, we can see what's coming next and we need to change the offering and change the mix. Now, I think what's happened at Wix, for example, is great. That there's a perfect example of a business that could have done very badly in this last 2-3 year period, but it's actually done very well. I would imagine that they will continue to do well if the consumer does spend in a low rate environment.
Yeah.
Similarly, I think the likes of a Churchill China, where the hospitality environment has been very weak, very soft indeed. They mentioned in the last statement that things seem to be stable. The pub sector started to purchase again. That could be a hint of things to come. So I think all of those could potentially do better. But that is really, I think, the later cycle stuff that picks up once you've had the rate cuts with 6 months to a year of being able to enjoy that.
Yeah.
Where does it settle? Who knows? I think it's difficult to predict these things because data keeps changing. We've had data today suggesting there's actually, lower inflation than some had expected. If you look at it more closely, it's not that low. It's 0.1 off.
Yeah.
But 3% is a good mark, and it's better than 3.4. It's not quite 2%, which is where the goal is, but the direction seems to be heading increasingly towards 2 rate cuts. It allows, I think, the MPC to have that debate.
Yeah.
And to a certain extent, it will also depend on what the rest of the world is doing. So if the US does indeed lean towards another cut, it makes it easier for the UK to do it.
Let's wrap up effectively where we, to a certain extent, where we started, which is that you are different. You're in terms of you're offering this sort of broad basket of stocks to people. And I think taking a step back and looking at what's happened in terms of the shift to the market, you're seeing, narrow leadership move into diversification. You're seeing a push effectively into value and income. And ultimately, I think, you're seeing, particularly with all the noise around AI, a shift into real assets. People are looking for sort of real assets. You also, all the way through 2025, my poor colleagues at the London Stock Exchange kept being beaten up about, the state of the UK market, etc. I've always felt that, capital ultimately starts to sort of take care of these things. I'm just curious, you're a UK-based manager. How do you view the UK? What are the attractions of the UK? What would your pitch be in terms of, why people should take a look at the UK market?
Well, I'll tell you, Neil, I think the first and most simple way to look at it would be to just take that label off, whether it's the UK, North America, China, it doesn't matter. For a moment, you have to look at the market itself in terms of the underlying numbers and say, would I buy a market which is trading on a multiple of 12 times? And I'm not referring to the large cap market in the FTSE 100. I'm talking about the smaller end of the market, where the balance sheets are on average net cash or low gearing, and where they have tremendous free cash flow covering dividends, yielding closer to sort of 4.5% rather than 3%, which they are now in the FTSE 100. And that wasn't seen. That hasn't been seen that level. I think it was the last time was GFC or thereabouts. So that tells you about valuations. Fine. So this is not about, is it the UK or is it somewhere else? It's just starting with the numbers in absolute terms. Is that attractive? And then you delve deeper and you look at the companies. And again, let's take the names off for a moment. Are these types of companies interesting in their market spaces where they can take share, they're run by good leadership, they have good quants underneath it, and actually the order books are good, and they're giving you good trading statements and they're trading ahead of expectations? Well, normally the market reacts to that. And when it doesn't, I think at some point you get the M&A triggers, and we've seen increasing amounts of that. I would say, unfortunately, to a certain extent, because a number of these are getting taken out at relatively low multiples. So I mentioned one company earlier, and I will say 1.1% of AUM is not a good multiple. It should be 2.5%, 3.5%. But in this particular case, there's very little a small fund manager can do. You have to accept what's given because there's a majority family shareholding. So, okay, that aside, you've got M&A going on, that's a green light. You've got the quantitative factors, that's a green light. But there are also risks. So I think when you get a few more stars align, the rate cuts, perhaps a government that actually is a bit more open about the reality of what's being told to them, that it's not been a good place to invest. It's been a terrible place. In fact, you could argue in the smaller end for the last 5 to 7 years, maybe even going right back to Brexit. But what has been done about it? I think the policies have been well intended, but a complete failure in my view. So what is rather than talk about problems, what is the solution? I would say you could just begin by giving a level playing field. So instead of us as consumers buying US companies with no stamp duty, I think you can apply stamp duty to foreign stocks to start with. And then this is not only as a revenue source for the Treasury, this is also just saying, well, maybe it's a small element to make you think again that, you've got your home sort of domestic facing stocks, why not buy British? And it's a question. It's also, I think, a mentality shift that's required. I hear so many people, including finance professionals in our own industry, talking about how they bought this or that US company in their own personal accounts. And I think that's to start with us, really. If you aren't buying British companies, I don't think anybody else will. And it's only when you start talking about those stories that, oh, look, I had Schroders, or I had, for that matter, another JTC, which we do hold in the fund, which is not a FTSE 100 company, and it got taken over at a premium. Well, that's when people start suffering from FOMO, or fear of missing out, and maybe start to look at some of these other businesses. I can think of another smaller company today that has been totally derated by 16, 17%, in fact, Keystone Law, and it's come out with a great trading update. It's actually ahead of expectations. It was never in doubt, in my view, but there's a perception that, oh, they might suffer, and actually it hasn't suffered at all. So I think those opportunities, I think raising awareness and having a more positive attitude will help. But the really important thing, I think, is when you hear of these mansion house compact policies essentially suggesting let's buy private assets. Again, fine as a general step, but the private assets, one can now argue, is that more risk? Why not have smaller company assets, which are also in the listed space and are profitable and open to scrutiny and very clearly valued, where anybody can look at it? I think that's what really we should be buying as pension funds, or even sort of greater sovereign wealth funds eventually sort of start looking at these smaller companies. It may never happen, but I do think there is merit in just assessing it again, because the policies seem to me completely misguided. I mean, I don't want my state pension buying private assets, I can tell you that. So I worry when this advice is given, whether we even have the talent to actually manage it properly. But coming back to the UK smaller company listed space, there is a lot of talent, good talent in the management. And I think, again, the franchises, they are regarded very well. So at some point, I think value will out, but it's not without risk.
Yeah, no, I love that. I think it's a great in like all of these things, there's a good side and a bad side, or positives and negatives, and we have to work our way through that. Sid, absolute pleasure having you on the show. I always love, having you here because I learned so much more about the market. We wish you luck for 2026, and would love to have you back in due course to hear an update on the portfolio.
I'd be very grateful. Thank you.